Did you know that you can use rental losses to wipe out thousands of dollars in taxes on your W-2 income? Most people think real estate is just about the cash flow, but the real wealth building secret is in the tax savings. But the problem? The IRS treats rental losses as passive, meaning they can't normally offset income from your job. But if I told you there are 3 key ways to turn those rental losses into huge tax saving deductions that you can use against your W-2 income to significantly reduce your taxes? Well, in this video, I'm going to break it all down, and stick around to the end because I have a bonus tip that you're not going to want to miss. All right, so the first way to use rental losses is known as the special loss allowance, but this one comes with a big income limit. If your modified adjusted gross income, or MAGI, is under $100,000, you can use up to $25,000 of rental losses to offset your W-2 or other active income. Here's how it works. You must actively participate in the management of your rental, so this means screening tenants, improving repairs, things of that nature. But if your MAGI is between $100,000 and $150,000, this allowance begins to phase out. Let's go through a quick example. Let's say you make $90,000 from your job and have $20,000 of rental losses. You can deduct the full $20,000 against your W-2 income, lowering your taxable income to only $70,000. But if your income is above $150,000, you get nothing. That's why higher income earners need to use the next 2 tax strategies. If you make over $150,000 and own midterm or long-term rental properties, the real estate professional status, or REPS, might be the most powerful tax strategy you can use. Why is REPS so powerful? Because it turns rental losses from passive to active, meaning you can deduct them against your W-2 and business income without limits. But how do you qualify for REPS? Well, first, you must spend more than 750 hours per year in real estate activities, and more than half your total working hours must be in real estate. For example, if you make $200,000 in your W-2 job and have $100,000 in rental losses, you can't normally deduct them. But if you or your spouse can qualify as a real estate professional, those losses can directly offset your taxable income. But there's one common mistake. Being a real estate investor does not automatically qualify you for REPS. You have to spend significant time managing your properties, renovations, acquisitions, and other real estate activities. Okay, but what if you can't qualify for the real estate professional status because you have a full-time job? Well, that's where the short-term rental loophole comes in. This is a game changer for W-2 earners because you don't need to spend more than 50% of your time in real estate to unlock the tax benefits. So how do you qualify for the short-term rental loophole? Well, first, your rental must have an average period of customer use of 7 days or less. We're talking about Airbnb and VRBO properties. Next, you must materially participate, which typically means spending more than 100 hours managing the property and more time than anybody else. If you meet these 2 tests, then the losses from your short-term rental will become active, and you can use them to offset your W-2 income just like REPS. Here's an example. Let's say you're a doctor making $300,000 per year. You buy an Airbnb, you do a cost segregation study, and you generate $80,000 in paper losses. And since you materially participated and you met all the requirements, you can now use the losses to slash your income to only $220,000. But here's a quick warning. If you use a property manager, you likely will not qualify because the IRS assumes that you're not materially participating. And the same thing goes for REPS. If you have a property manager, you likely won't qualify for that either. Now for the bonus tip. What happens to your losses if you can't use them in the current year? Well, suspended losses don't just disappear, they get carried forward to future years, and you can use them to offset other passive income that you might have. And when you sell your property, any remaining passive losses become unlocked. Let's give an example. Let's say that you have $100,000 in passive losses from previous years that you couldn't deduct on a specific property. Well, the moment you sell that property, the losses become fully deductible in that year. That means you could potentially wipe out your capital gains from the sale and even offset other income. So there you have it. Those are 3 ways you could use rental losses to offset your W-2 income. If you want to learn how to implement these strategies right away, hit that like button, subscribe to the channel for more real estate tax hacks, and let me know which strategy you plan to use in the comments below. And if you want to see how much you can save, then check out the link in the video description for a free discovery call. I'll see you there, and I'll catch you in the next video.